In this episode, teaching robots to feel because we often fake our feelings. Having an avatar CEO is the new trend. Making money by having an imaginary person online. And for the porn addict, we have good news for you. Hello and welcome to Business News Weekly, where market charts meet meme-worthy collapses. Startup valuations defy gravity and logic, and we decode the economy with a scalpel, sometimes blunt, often sarcastic. Whether you're an investor, entrepreneur, or just here for the financial drama, buckle up! With tech's new golden goose, pick startups that you may like to invest in, or the next Bitcoin may appear while you're not watching.
Showtime.
Intempus, teaching robots to feel, the future of emotional AI. Imagine a world where robots don't just perform tasks, but also understand and express emotions. Meet Teddy Warner, a 19-year-old innovator who's making this a reality with his startup Intempus. Growing up in a mechanist shop, his fascination with robotics led him to groundbreaking idea, giving robots a physiological state to make them more human-like in their interaction. Instead of focusing on facial expressions, Intempus emphasizes kinetic movements, like the way we move our arms or shift our posture. To convey emotions, this approach taps into our innate ability to read body language, making robot interactions feel more natural. Traditional robots operate on a simple model: observe and act, but humans have an intermediate B-step, or our physiological state, that influences our reaction. Intempus aims to bridge this gap by integrating sensors that monitor sweat, heart rate, and body temperature, allowing robots to exhibit emotional responses. Since its inception in September 2024, Intempus has partnered with 7 enterprise robotics companies and is backed by the prestigious Steel Fellowship. The goal: to enhance human-robot collaboration by making machines more intuitive and relatable. As we stand on the cusp of a new era in robotics, Intempus is leading the charge in making our mechanical companions not just smart, but emotionally intelligent. Great! Now robot can feel stressed too. Can't wait for my toaster to have a midlife crisis. It's kinda scary funny how we are teaching robots to have emotions while humans scroll past daily genocide like it's just another episode of the show. Maybe we should install empathy in ourselves before upgrading machines. Klarna used an AI avatar of its CEO to deliver earnings. Klarna CEO has an AI clone now, and it's doing his job. Sebastian Chemyatskowski, CEO of Klarna, just introduced quarterly earnings using himself, but not quite. It was his AI-generated avatar delivering the financial highlights in a YouTube video, as Klarna doubled down on branding itself as a full-fledged AI company. Klarna's AI makeover, not just a gimmick. The AI version of Chemyatskowski looked real, save for some robotic blinking and slightly off lip sync. The virtual clone even wore a jacket identical to his corporate headshot. Fashion continuity matters apparently. Klarna credited for AI helping it achieve 4 consecutive profitable quarters, increased revenue per employee to nearly $1 million, cut its workforce by 40%, shrinking from 5,000 to around 3,000 staff. The company claims AI has been instrumental in hitting 1 million users and improving efficiency across operations. This isn't the first time the idea has been floated. AI startup Artisan previously joked that their CEO was replaced in April Fool's campaign, but the joke's wearing thin. In fact, a 2023 study from Harvard Business Review using GPT-4 found that AI could outperform human CEOs in a decision-making and strategic planning until a black swan event hit, like the COVID crash. But advocates argue it's just version 1. Imagine working at a company where your boss is an AI and still gets to wear better clothes than you.
Shame on you, shame on you.
The startup revolutionizing retirement planning. Hello, savvy savers and future retirees. Today, we are diving into a startup that's making waves in the retirement planning world. Smart Asset. Let's explore how this fintech company is reshaping how Americans prepare for their golden year. Founded in 2012 by Princeton Michael Carvin and Philip Camilleri, Smart Asset began to simplify home buying decisions. Fast forward to today, it's a comprehensive financial tool assisting millions with retirement planning, tax strategies, and more. In 2021, Smart Asset achieved unicorn status, securing over $161 million in funding and reaching valuation exceeding $1 billion. Their mission to make financial planning accessible and straightforward to everyone. Smart Asset offers a free, user-friendly tool that matches individuals with vetted fiduciary financial advisors in their area. These advisors are legally obligated to act in your best interest, ensuring trustworthy guidance. With over 110 million Americans over age 50, the need for reliable retirement planning is paramount. Smart Assets platform reaches approximately 75 million people monthly, providing calculators, educational content, and personalized advice. Smart Assets' innovative approach hasn't gone unnoticed. They have been finalists for the Best Wealth Management Solution at the Finovate Awards and have received accolades for their user-friendly interface and comprehensive tools. Users appreciate the simplicity and effectiveness of Smart Asset services. While the matching service is free, it's important to note that the financial advisors may have their own fee structures. Always ensure you to understand any associated costs before proceeding. Smart Asset is transforming the retirement planning landscape, making it easier for individuals to secure their financial future. Whether you are nearing retirement or just starting to plan, tools like Smart Asset can provide a valuable assistance. Who knew that planning for retirement could be as easy as online dating? Swipe right on financial security. OnlyFans for sale. Because nothing says tech unicorn like monetized nudity and mild lawsuit. And now to the adult section of our economic headline, strictly for research purposes. OnlyFans, the platform your roommate insists they only knew from memes, is reportedly in talks to be sold to a U.S. investment group in a deal that could value it at the modest, saintly $8 billion. Yes, billion with a B. For the platform that single-handedly turned lockdown loneliness into a multi-billion-dollar industry, one paywall photo at a time, with 4.1 million creators and over 305 million users. OnlyFans isn't just a creator economy success, it is a masterclass in selling digital intimacy with a 20% commission fee and no return. Of course, there is always a touch of drama. While the company swears it's not just for adult content side, it faced accusations of hosting some not-so-legal content, including reports of trafficking and underage material, issues it insists it's fighting. Back in 2021, they even tried to ban NSFW content entirely, like McDonald's banning fries. It lasted about 5 minutes. And yet, despite the moral chaos and the PR minefield, the financials are eye-watering. $485.5 million in profit in 2023, up 20% year-over-year. Its elusive owner, Radvinsky, has already collected over $1 billion in dividends over the past 3 years, proving you can make it big if you just believe in scalability and nudity. So if you're still debating your next business move, just remember, while startups are burning cash trying to sell AI to other AI, OnlyFans made $8 billion out of selling what people were already paying for offline, and they did it with better margins. Platforms like Patreon and Substack are also evolving, but none have cracked OnlyFans' monetization model. Forbes caps how traditional creators platforms still struggle with sustainable profit model despite user base growth. According to The Guardian, OnlyFans attempt to clean up its image and appeal to mainstream investors has hit walls, especially with institutional funds avoiding anything remotely controversial. A 2024 Reuters piece report that U.S. regulators are increasing scrutiny on platforms suspected of hosting or failing to prevent harmful content. Any acquisitions of OnlyFans may come bundled with compliance headaches. There is a quiet boom in adult tech investment, especially around privacy-first platforms, crypto payments for creators, and niche fan platforms. Business Insider called it the $100 billion niche no VC wants to tweet about. Sounds like it has a connection with money laundering. At this point, considering the direction our world is heading, maybe we should all keep a close watch on Feedfinder, because apparently, even foot fetish can be monetized into empires when you mix them with digital platforms and the global shortage of shame. Stay tuned for the next episode, hit the like and subscribe to our channel.
Until next time!